Welcome to this session on the topic of high frequency trading, and welcome also to Blackwell Global. My name is Malte Kaup, and I look forward to walk you through this session in the next 45 to 60 minutes. Before we go into the topic, obviously it's important to have a look at the risk disclaimer. So risk warning says that Forex and CFDs are leveraged products and involve a high level of risk and can result in loss of all your invested capital. Therefore, Forex and CFDs may not be suitable for all investors. You should not risk more than you are prepared to lose. Before deciding to trade, please ensure you understand the risks involved and take into account your level of experience. Seek independent advice if necessary. And there's more information here, and it is in fact important, given the risky nature of the CFD products. They can work in your favor, can also work against you. So nothing we discuss today should be seen as investment advice. Blackwell Global Traders Leadership Council and myself, Malte Kaup, are not financial advisors in that context. With that said, let's focus on the topic, and it's one that you, the clients of Blackwell, said is really interesting for you. So I'm very happy to oblige and to generate some new fresh material to give you a good insight of what does it actually mean with high frequency trading beast. It's been reported quite a lot in the media, but I think it's also being massively misunderstood. So don't worry, it's not a kind of a history lesson. We'll very quickly move back to 2010 and beyond. But just to give you a bit of context, let's rewind the clocks a little bit and go all the way back to the Battle of Waterloo in 1815, where effectively Napoleon has been defeated. Well, and just picture yourself, and when you look at kind of the accounts of historic accounts at that time, it was actually not very clear who would emerge as, the winner out of this battle. Would it be Napoleon or would it be the other side? And imagine if that is unclear, and just relate it back also to the time that we have right now, and you have that information on the battlefield, and you would be able to, on your MetaTrader 4 platform, you would be able to trade immediately before that news hits the wires and gets distributed more widely. Then you would be able to benefit from that time difference, right? Between you having that advantage with the information and on the other side, the information then being disseminated to a larger group of traders. So that creates almost like a low risk opportunity window for you to trade. And that's obviously what everybody would have been after at that time. And legend has it, and I think we're just twisting the facts a little bit, but I think it's also helpful to understand what has happened back in the days. Legend has it that by the time it was clear that Napoleon has lost the battle, then somebody sent off a pigeon, a carrier pigeon, with that information and sent it to London. I say legend has it, but more specifically, the legend says that it has been sent to Nathan Rothschild, the founding father, basically, of that very well-known bank. And we talk a little bit about his wealth. The bank is still around today. So the legend has it that that pigeon then got sent off to London to the Royal Exchange, where Nathan Rothschild was sitting at his usual spot, or standing at his usual spot in the Royal Exchange, and he was then able to trade on that information advantage that he had, right? So imagine you have that information, and if it's just an hour or so, back in 1815 time, that is probably not a huge time span. Obviously, today that would be a massive time span. Imagine you have an hour, the market is open, you have that information, and you have capital to trade. And you know what the outcome of the battle was. That will enable you to make massive profits, because you know that, for example, if you think about it in today's terms, the British pound would appreciate, maybe the euro would go down. You can put your bets on that. The stock market will probably rally in the UK, and will be depressed in France. So there's a lot of opportunities to make low risk bets, and that's what Nathan had done at that time, and that was part of a reason why he may amassed such a fortune. In 1815's money, that was around £3.5 million. But just to give you an idea how far £3.5 million would get you in 1815, that was more than half, I think, even more than 60% of the gross domestic income of the UK at that time, right? And that, if you compare that to, let's say, somebody who's super rich like Bill Gates, I think his wealth if you related that to the US household, is about 49% or 40% of the US household. And Nathan Rothschild's wealth was more in the region of 60%. So he was able to amass a lot of money, and I'm not just saying based on kind of his information advantage, but he was clever enough to create that advantage. It's not illegal, right, to have a carrier pigeon or to have a system where kind of really fast performance horses race from one point to another, and you switch horses, and you're just very, very fast in transmitting information from A to B, much faster than the traditional ways of passing on information. And basically, if you just visualize that concept, I think that tells you a lot about high frequency trading and what these systems are trying to exploit, because basically it's a similar principle. So let's fast forward now to 2010, and let's shift over to the United States of America. And what I've show you here is a picture of a map of the Chicago and New York area. And if you would have tried in the, let's say, early 2000s, if you would have tried to send a buy or sell order from Chicago to the New York Stock Exchange and back, because you need a confirmation if an order has been executed or not, well, then that would take a certain amount of time. In fact, 16 milliseconds was the time it would take if you just use the standard fiber network of a provider like AT&T or Comcast, which are well-known providers of telecommunication providers in the US. However, their system doesn't operate in a straight line because nobody really designed it to be in a straight line. There are mountains, there are lakes, maybe there are buildings, and there's land where you just can't dig through, and there was no desire from anybody to put the line in really a straight line because there was no economical benefit to be had by the likes of AT&T and Comcast. However, what some people already at that time realized was that sometimes you send an order via, let's just stay with the example, Comcast. So you send it via a Comcast network, and in one case, it was 21 milliseconds, and you do the same thing, and suddenly it's quite consistently below that. It's 16 milliseconds, just for argument's sake. And some clever people then realized that, every time you send a signal, it kind of gets routed through the network. It is not always the same dedicated line the signal gets sent through. And some people at that time already said, all right, let's have a negotiation with Comcast to make sure that we always use the fastest line when we send our buy and sell orders from Chicago. And then we already have a time advantage of the others. We don't know if we always have it because we don't have exclusive rights to use a certain line, but we have a good possibility that that is the case, or even more importantly, we know we always have the fastest connection that's out there in the market. And just to give you a perspective how little time and how short 16 milliseconds are, I looked up how long it takes for the human eye to blink. Blinking doesn't take a lot of time, but in milliseconds, that's an eternity. It's 400 milliseconds, in fact. So it only takes 16 milliseconds, which is a fraction of a blink of an eye, to send an order from Chicago to New York and to get the confirmation back. But spread networks, a company that emerged when in the kind of a mid 2000s, they saw an opportunity to create a line that was significantly in milliseconds, significantly faster, and they saw an opportunity to sell that to the market because if you have a faster line, basically everybody who's interested in getting a best price and getting a good execution will have to buy some bandwidth in your line. And that's exactly what Spreadco tried to do, and not just try to do, that's what they did. So just to give you a perspective of distance, I included here the screenshot of a Google map, where you can see if you drive with a car, kind of the shortest distance from Chicago to New York, that is around 800 miles. So in the round trip, a round trip is 1,600 miles, and that happens in a time span of 16 milliseconds, as I just defined for you. So it's quite a distance, right? But when you travel at the speed of electricity or you travel at the speed of light, you can get there and back really, really, really fast. And you can see that if you drive with a car, the roads are actually quite okay. You know, it's almost like a horizontal line from Chicago and New York. And when you look back at kind of the old line and the old connection, it had some twists and turns and went all the way up to the Niagara Falls and so forth. So that was just a longer line at that time. And here I've got for you an original screenshot of the map that spread networks actually used for their lines. You can see it's not perfect. That's why we already have some new technology, and we come to that also in a moment. But it shows you that there is a fairly direct connection now between Chicago and New York. And not only that, there are also a lot of points where you can connect into that line. So that also from a sales marketing point of view is great, obviously. If you are, let's say, a hedge fund based in, let me pick something out, in Cleveland, right? You sit right on top of that super fast speedway between Chicago and New York, and you can try to benefit from that. That's why HFT, high frequency trading hedge funds will try to position themselves very close to that line to get kind of maximum speed for their execution of trades. It was not cheap. Let's be honest there. It cost them about 300 million US dollars to build the line, which included kind of a lot of secretive activity, a lot of kind of unmarked high visibility gear where people were just kind of working, and even the people working on it didn't really know what we were doing other than just kind of putting some cable, some fiberglass cable into the ground. And a lots of negotiation with landowners and making sure that the cable, the fiber cable is, or the fiber line is kind of really moving in the straightest line possible from Chicago to New York. And then finally, after a while, a couple of years, they had this line finished. They've done it. They kept it completely under wraps. Again, it was a very kind of secretive initiative. And if you want to read more about how that has been done in detail, you may want to have a look at Flash Boys, the book that's been written by who is it? Michael Lewis. He sat down with the people who built the networks, and he is uh, in a really compelling way, he articulates how they've done it and how that then had an impact on the capital markets. And the second part is something we're going to talk about right now as well. So finally, the line was ready. Imagine 2010, and they fire a buy signal from Chicago to New York and back, and they measure the time it takes. And that was just 13 milliseconds. So they achieved through an investment of $300 million an improvement in transmission time for a round trip, Chicago, New York, of just 3 milliseconds. And remember again, blink of an eye is 400 milliseconds. So that's really, really, really fast and not a lot of time. But when you're a trader in the markets, every millisecond is eternity, right? Imagine if you're always consistently 3 milliseconds faster than the competition, that creates an edge, that creates an advantage. And that's exactly what high frequency trading is all about. That's exactly what high frequency trading is exploiting. And I will share with you very specifically the strategies that high frequency traders are using to leverage that advantage. So the idea was 3 milliseconds can generate billions for hedge funds and a large amount number, probably also billions for the HFT firms, and a very very large number also for company that owns the network. But there's always you probably heard of the term arbitrage opportunity. When you create something which is basically a low risk or risk-free opportunity in the market, these arbitrage windows close very fast, and you're not able to capitalize on those for long because the competition will catch up and find a way to deal with that advantage, or maybe find a better way. And that also happened in the context of high frequency trading through this fiber line between New York and Chicago. It still exists, right? It's still being used, but in the kind of the speed to in the race to speed and being faster and faster and faster, there are already better lines available. So let's have a look at kind of the actual impact 3 milliseconds can have. And you just use kind of the speed of light as a comparison. I looked that up and I asked the question, how far can light travel? Because at the end of the day, when you take a fiber cable or a fiber line, it's light traveling through that line. Light can travel 560 miles, or for ones of you who like the metric system, 900 kilometers in 3 milliseconds. And that is obviously a quite significant advantage in trading. I was looking for kind of comparisons, what is roughly 580 miles. Well, if you're based in London and you want to go to Zurich, it takes you probably 1.5 hours, depending on the weather, in a plane to get there. But light only needs 3 milliseconds to go there. If you would theoretically, if we have a direct connection between London and Switzerland, just to give you an idea of the advantage. So we're talking about an advantage when you talk about 3 milliseconds less in terms of trading between Chicago and New York. It's similar to the distance between London and Zurich. So you're always significantly faster when you use that network, when you use that line. So that's the first key kind of learning, hopefully, from this session, that HFC is always a step ahead. And as we go through quite complex topic again, I think the colleagues from Blackwell are on hand to answer any questions, but let me focus on getting through the content and make sure that we get that right. HFT is always a step ahead. Don't try to compete. Don't try to compete with high frequency trading. You will lose at the end of the day. I think that's a key learning from this. Stay well clear of HFT. But nevertheless, what else have we seen out there? So suddenly, there was a realization that 16 milliseconds is also not, the fastest connection between Chicago and New York. And I know there was a lot of blame at that time also on the SAC that they are just not fast enough to see and regulate what's going on. And also the SAC suddenly was driving something that was a bit kind of hidden and mysterious. And what you see here is actually something in the UK. It's a British Telecom tower with these kind of weird, and they're not satellite dishes, but these weird kind of dishes that are clearly lined up in a more horizontal way. So we're not looking into the sky. So what are these? They are microwave towers. So traders started using microwaves because they would travel, first of all, as you can imagine, in a perfectly straight line because they travel through air. You don't need to dig anything, so that's much faster. And you have an even shorter way of transmitting information, and also a microwave is obviously extremely fast. But if you just look at it from a distance point of view, you are straightening the line, first of all, even more. The problem that they saw with the microwave towers was that compared with a fiber network, the bandwidth is much less, and obviously it's also not perfect when you have completely adverse weather conditions, when maybe the transmission of data is impacted, right? So you don't want to always use all your strategies on microwave because of these reasons. And then after the microwave tower, suddenly some people started again mounting devices to towers. And this was something I saw on a Zero Hedge website, when they figured out that they now started using these interesting looking devices with kind of these two kind of one with an optical lens and the other one looked like it's not necessarily an optical lens. And they quickly found out these are lasers, and you can quite easily Google that, and there's some interesting videos also that show you these lasers in action. And basically, what they do is laser is faster, even than microwave, but more importantly, it's also more robust in terms of transmitting information and keeping the connection. So what you can see is the laser here has kind of these two output devices. And one output device works quite well even if it's raining, and the other output device works quite well even when we have some fog. So if one is compromised by adverse weather conditions, the other is still working fine, and vice versa. So that gives a lot of stability to kind of eliminate the problems that weather can create. Secondly, when you look at the devices, they are also they have a kind of a little engine in there, and they can move around. So if this tower is moving left and right because the wind is blowing, that is being adjusted for by the laser immediately, and it generally keeps the connection unless we have like a real tornado or some winds of that kind blowing. Then even our high frequency friends will suffer from connectivity problems, right? But we even know that from our own internet connection that connectivity problems are quite a reality and not just a myth. Again, you look at the advancement of technology, and when you think about it, you just build a line for 300 million, and somebody comes up with microwave technology, you immediately obsolete, right? And you probably have to drop your prices quite significantly to get your clients using your line. So let's have a look at kind of what has happened in terms of timings. So we had this reduction of transfer times from 16 milliseconds down to 10 milliseconds with microwave. And then they improved the technology, and there probably I lack the detailed knowledge what was the reason for that improvement, but they reduced that to 8 milliseconds. 8 milliseconds. So they've taken away, imagine 3 milliseconds was the distance between London and Zurich. So they've taken another, if you compare it with distance, round trip London-Zurich away to arrive at 8 milliseconds. That's unbelievably fast. And an advantage that the laser introduced was when that there is literally no latency in the system, just 0.18 milliseconds. And if you ever, wonder, just to give you a practical example, why you don't really get a good feel after the unemployment number in the US, the NFP number is being released, well, here's your answer, right? Because HFT will always be able to process that information faster, and on a scenario basis, they can just say, I'm buying, I'm selling, I'm doing whatever. They will just always be at least a step ahead of you when it comes to putting the order into the market and putting the order into the market and benefiting from the order. There even have been measurements, and that is probably only theoretically possible because execution systems are probably now getting too small, too slow. That's the right word. That you have almost like a negative time between opening an order and closing an order. So we are pushing it to that extreme level. The systems are so fast now, but the execution systems now sometimes lagging behind and need to improve the performance dramatically. I was looking for an example to talk about nanoseconds because right now we're not talking about shaving off another millisecond of that time to send a signal from A to B. Now we're talking about nanoseconds. So nanoseconds are so short. I was looking for a good example in the internet, and there was actually an American military lady who did a really good job at explaining that to her students. She she came up with an example, and the question was, how far can electricity travel in 1 nanosecond? And that is really short length because electricity can only travel 11.8 inches or roughly 30 centimeters in 1 nanosecond, right? So compare that to the London Zurich example that we looked at a moment ago. Now we're looking at 30 centimeters of a kind of electricity length it can travel. So that's the kind of environment we are now in when you see kind of the fight with between the HFT providers. So let's have a look at some kind of real life examples. Nanex is a quite well-known company for doing a good job at publishing statistics and data on HFT, and transparency, I think, is really key in this space. And what you see here is 27 seconds of HFT stock trading actually going wrong, and we will further zoom in a second. But every yellow dot you see here indicates a buy and a sell decision by an algorithm of a HFT player. So imagine if you would need to trade at that pace manually, it would be absolutely impossible to position thousands of trades in a minute. So let's zoom into this picture, which is like one one box here represents 25 milliseconds, right? So let's zoom in massively and look at 1 millisecond per box. And you can see that in 1 millisecond we have about 3 or 4 orders being executed in some of the milliseconds, and some others only two, and so forth. But if you add it up, and that was actually a well-known example of an algorithm or a bot gone completely crazy, this thing fired 2,400 trades every minute, and each trade was actually losing trade of about 15 cents. So imagine if this thing is running for a couple of minutes or 10 minutes or even half an hour and an hour, you're done, right? Because you're just kind of throwing money out of a window. And obviously, with that volume that you're trading, you have an impact on the market. You will be a driving force in the market if your funds allow you that. I think again, if you relate that back to the CFD retail trading community, there's no way that you have the funds in your account to trade at that kind of frequency and volume. No way. Second example I want to share with you, maybe you've seen that before, is in natural gas. So suddenly the volume was exploding from what you see here on the top, you see the price, and the bottom you see the volume. And if you see on the left, kind of the volume was pretty stable on like 100, maybe 200 contracts being traded. And suddenly, bam, HFT comes into the mix, and the volume explodes to 2,000 contracts from maybe 100 and 200. If you say 100, it's like 20 times the volume in the market is suddenly being traded by one algorithm. You can imagine that somebody's probably suffering or somebody's making a killing, but to execute 2,000 contracts in such a market environment obviously immediately pushes price. And that's exactly what has happened. If you look at the example there on the top right, how the price has moved up in that short time period. And that has nothing to do, with regular market conditions. That if you do your technical analysis or breakout strategies, things are happening so fast, you will never get a proper fill on anything, so you can't be really in on that trade. And that's a behavior that really needs to stop. I think there are two schools of thought out there. One says HFT is great because it provides liquidity needed to always get a counterparty for a buy or sell order that you position in the market. Then on the other side, when you see these kind of behaviors, these are clearly predatory behaviors, which are not good to instill confidence and trust in the market, and that's not good if you want to put your hard-earned money into the market. So that was really a disaster when that volume suddenly, and often in some cases in times where there's really very low liquidity in the market, and suddenly boom, things explode and explode typically right into your face. So I was also doing some research on how to tackle this HFT and this really negative and bad behavior. And one really good academic paper is looking at it, and they say a large problem of that is that Trading happens continuously. So you go to the market, you put in, let's say, a market order, and you want to have it executed immediately, and possibly you get a fill immediately. So trading is continuous. But if you go to that microscopic level of HFT and we talk about milliseconds, right? That could be a problem because somebody who has more speed in trading could always be at an advantage compared to somebody who doesn't have that level of speed. So one could kind of split the trading day in little pieces of 100 milliseconds where you are allowed to trade. I suppose HFT, being very clever, they would then still in the 100 millisecond slots, if we ever to introduce them, try to get the execution first and probably pay for that privilege. But to slow down trading to that kind of level would make it really, really hard for HFT to turn any profit, and probably a lot of HFTs would look at other opportunities in the market to make money. I'm not saying that's the right thing. I'm just saying that that is a kind of a prominent view that this is how kind of the negative behaviors of HFT possibly can be reined in. Let me give you some specific examples because I think that really brings it to life, doesn't it? So one thing is we look at one day here at the S&P 500. Everybody knows the S&P 500, a US index, 500 large companies, and the corresponding future, the SPY. And the SPY is very, very, very popular among traders. It's a beast. It's hard to trade, but it's extremely liquid, and a lot of big, powerful traders kind of playing the SPY. And naturally, the underlying index, the S&P 500, then correlates very closely and narrowly to the future, right? You know that. If you want to look at such a correlation from HFT point of view, you say like, all right, if I know that the correlation between S&P 500 and future is equals kind of lim 1, as close to 1, then any kind of time frame I can find where there is a disconnection between the S&P 500 and the future, I could exploit that with the theory that they will kind of come back into sync again. So if S&P goes up and my future lags a little bit, I could go short with S&P and long the future until they clash again or get closer again, and thereby create a very, very low risk strategy. Obviously, we're talking about many kind of points that we make here. But if you are able to put an enormous amount of volume behind that, then this can work, and boom, that is your low risk or risk-free strategy. But looking at this daily chart, it's really hard to pinpoint where are these opportunities because just from looking at it, right, most of the time, really, the two financial instruments are working absolutely in parallel. Let's drill in a little bit more. Let's go to the hourly. Let's have a look on the basis of an hourly. And again, I think, yes, maybe we can see a little bit of lagging here and there, but generally, these lines are moving in parallel. These lines are moving in parallel and really hard to make a profitable trade on any of the potential arbitrage opportunities here. Let's drill in even more. Let's have a look here at the minute candles. So this is just 1 minute in the afternoon, 1:51 and to 1:52. And even here, it's really hard to see a lot of differences. Maybe here you see a step up and then it takes a little bit for the future to react. But in general, unbelievably hard. How would you want to make a profit here? So let's put our HFT hat on and drill in even more. And now we're looking at 250 milliseconds, which is roughly half the time it takes to blink. And suddenly the picture looks different, right? Suddenly the picture looks different. On the left-hand side here, you can see kind of in the first 50 milliseconds, nothing is happening, but then suddenly price jumps up in the ES, the S&P 500, and the future is lagging behind. That's what you're after. But you have to go down to that level or even lower, right? I was talking about nanoseconds now to create an advantage where you could then potentially short S&P at this high point and long the SPY at the low point until then, later, they come together and both trades turn a small profit if kind of obviously if a commission and a spread work accordingly. But that's what an HFT arbitrage trader is after. Risk-free opportunity to trade in a market, kind of pick up a penny and let's just make that 1 billion times. And that's what they do. If you look at arbitrage opportunities over time, if you kind of zoom out a little bit, then you will find that it is increasingly hard to benefit from these opportunity. So when you look at the correlation, and we always stay here between the S&P and its future as an example. If you look at the correlation over a time interval, then in 2005 that is actually comparably low if we really stay on that 100 millisecond level. And I showed you the example that was 250 milliseconds. So the correlation on that microscopic tiny level was really low. But now with markets becoming more and more efficient and also the advance of the technology and everything in 2011 and now it has gone higher even more. In 2011 we suddenly we're moving up to zero point 0.5 in correlation. Still there's an opportunity, right? But the opportunity is a factor 20 smaller than it was in 2005. What difference a couple of years make. Or look at it from this perspective, right? So I look at the opportunity window and how long is it open and when does it close. And in 2005, the opportunity window is open, for a pretty long time. It's actually bigger than this 100 milliseconds that I depict here on this chart that I've taken from this paper. And when you go all the way to the left, you see in 2011, look, this opportunity window closes after roughly 20 milliseconds again. It goes like close to zero. And that's why there is this kind of race after the milliseconds, because that opportunity window is closer and closer and closer, or smaller and smaller and smaller. And if somebody then, would introduce specific times in the day, every 100 milliseconds, for example, when one was allowed to trade, probably that opportunity window would get almost completely closed. So let's have a look at a second term, that everybody is looking at is dark pools. What is a dark pool? Sounds like a very mystical thing. Well, a dark pool is born out of the idea that if you are a pension fund, right, and you want to make a really large order and you don't want to show everybody your hand, because if I know that there is a 500,000 shares order in a stock buy order sitting somewhere, I would love to front run this order. I would love to just be ahead of a queue and then behind me somebody buys 500,000 of stock of anything BMW, God knows what it is. And that's the idea of dark pools, where you don't really know the seller-buyer relationship. And that's front running. Front running is the idea that you try to sniff out an order, a big order, and you try to put yourself in front of it and benefit from that. And a dark pool is nothing else than a large number of computers, a deep network where these are the kind of transactions are happening. And dark because the seller and the buyer don't really know that they exchange in the transaction. That is happening in the dark pool that is being provided by somebody. And just to give you an idea, kind of, I've taken this from an investment management firm, and they made a really good picture here. And what it tries to get across is that the larger your order is, right? The larger your order is, if you're a portfolio manager and you want to buy or sell 100,000 or a million shares, the more vulnerable you will be to your order being sniffed out by a market and somebody wants to take an advantage. All the way down to the kind of a small position trader or a small sales trader at a broker. Nobody cares really because that volume is too small to move the market. So the good news is that this shouldn't really bother you because you're not affected, because you don't often trade 500,000 or a million shares of a stock. But it's important to know that these kind of things are happening out there. So this picture, I think does a good job at showing that whereas one money manager or a second or a third, they send their orders into the dark pool. They don't really know what's going on inside that dark pool. They just see their orders being filled. And on the other side, there are ECNs that route their orders or through or other liquidity providers and other institutions, but it's happening within that mystical dark pool. So let's have a look at an example of how HFT can actually exploit such a situation. What are they doing, knowing that they have a speed advantage in trading? So what they could do is they could ping multiple exchanges all the time, and let's use the example of Microsoft, and always kind of buy and sell one share, kind of move it back and forth and move it back and forth at absolutely minimal transaction cost. And that would give them an understanding if they suddenly see, that they are exchanging with kind of the same institutional trader or the pension fund at multiple stock exchanges, maybe they then suddenly see, wow, there's a big order coming into the market, being placed at multiple stock exchanges. Because if you buy 500,000 shares of Microsoft, that's probably not just happening on one stock exchange. That order will be stratified across multiple exchanges. So once identified by the HFT through kind of this sniffing of orders, iceberg orders, an HFT tries then to front run the order because they suddenly know, wow, there's a big order coming. They even get insight into how big the order is because they can aggregate the information. It happens so fast, right? We're talking milliseconds and nanoseconds. And obviously, what they then try to do is they try to run to the stock exchanges first, buy that particular stock, drive the price up, and sell it to a higher price than to Microsoft. Well, there's no risk in that, isn't there? So a chap who is also being kind of depicted and talked about in Michael Lewis's Flash Boys book, and you can easily Google him, and there's a lot of YouTube videos about him, is a chap who at that time worked for Royal Bank of Canada. And he suddenly realized, and he was very frustrated when every time he tried to position an order in a market at, I don't know, 10.00 to buy a stock, he pressed a button and suddenly the price went up to 10.10 or 10.05. And everybody kind of knew that that was happening, but everybody felt like, well, the market has moved a little bit. Why should I bother? But what really annoyed the guy was that consistency, that the market always seemed to kind of slide back a little bit from him when he put an order in the market, came back to the same level. But whenever he pressed that bloody button, the market moved again away from him. And this chap then did a little bit more in terms of investigating and trying to find out what is actually happening there. And then he after he hit a kind of a first of all he hit a wall of silence when he realized that nobody really cared about it, and kind of the more he understood what was happening, the more he understood that HFTs actually exist and that line between Chicago and New York exists, the more he was shocked, and he called it rigged markets and all that. The more he was shocked that there are organizations that create this arbitrage opportunity, and regulator wasn't even aware of that at that time, right? So I'm simplifying a little bit, but that was let me paraphrase it in that way, just to get the point across. But hugely frustrating for him. Press the button, market moves away from you, and it just nibbles off a little bit of your performance, and that's I think why nobody kicked up a big fuss on this topic at that time. But when you aggregate it up for the HFT provider, that was billions. That was billions of risk-free money that we're taking home. Again, if you're with your MetaTrader platform, um, you don't have to worry about that because you don't compete with these guys, and don't try to don't ever try to on a tick chart to try to put yourself in a position where you think you can be faster than the rest of the market. You can't. You don't have equipment. You don't have the lines. You don't have the hardware that's sitting behind that and the algorithms. So please don't get eaten alive. That's my second key teaching for you. Stay away from the idea of, automating a ultra fast tick-based scalping strategy. If you make that work, well done for you. I suppose you just create a lot of transaction cost and diminish and hit your account over time. What I've taken also here from a publication is the idea that high frequency is really, really fast. And I think I was talking about that now for more than half an hour. So basically what's happening is also the point I tried to make a bit earlier. You send your order maybe to a couple of stock exchanges, and the HFT will be able to find that order before it hits the stock exchange, and you just the other stock exchanges, and you will always get a price where you're worse off. You personally won't, because you're trading with Blackwell. You shouldn't be impacted by this. But as far as interest in this topic, this is what's happening really on an institutional level. And I think it was actually Credit Suisse who did a good job at kind of giving some visibility to the most prominent HFT strategies. And let me walk you through that. And now you will understand why I'm focusing on the content, just to make sure that we get the point across. Let's start with quote stuffing. What's that? So quote stuffing means that an HFT trader sends a huge amount of orders to a market, but then cancels in the last second. So that's pretty mean, isn't it? When you suddenly see in the order book, you see a massive order, gone. You see it there, gone. See it there, gone. See it there, gone. When you can take that to the next level, what's called layering. Layering is the idea that you have multiple large orders placed passively in an order book with the goal of kind of moving or pushing the book in a certain direction. So imagine, let's say, again, let's use the Microsoft example, and you put some bids just below the market to buy at three different prices close to the market, 1 million stocks each. So what will happen is you will attract a lot of buyers who speculate that your order gets filled at some point. And also on the short side, there will be people who see like, oh, there's an opportunity to move the market in that direction, because that's where it always like the orders act as a magnet, and let's see if we can get a piece of the action. But mostly you will attract buyers. And what happens then is, if you then suddenly the market moves towards your buy orders, and you pull order after another, which are you kind of perfectly entitled to do if the intent in the first time was of your order, your intent was to actually get it filled. But in reality, and that's the bad practice, you maybe sit on the other side of a trade, you're massively short, you pull the orders, and the market just moves through because the bid side is breaking way for a little bit. Again, we're not talking about 100 points that you make, but you maybe make half a point or 1 point risk-free out of it. And that's really the background of this HFT strategy. Interesting enough, there was a chap, I think his name is Navinder Singh in London. He was trading out of the living room of his family, semi-detached in Heathrow, close to the airport, and he was being accused of layering in a massive scale that would have triggered the flash crash. If that's true, and I would probably highly doubt that, but if that's true, I'm really worried about sometimes about our financial system. If you can just by putting in some orders, kind of on the sofa of your home, can trigger a 1,000 point decline in the key US market. Unfortunately, this guy got jailed and extradited to the US, and we haven't heard from him for quite a while. It is probably impossible to do that manually. That was something he claims he must have done it automatically. So it's a very bad practice indeed, but markets should be more resilient than that. In response to that, so-called circuit breakers have been introduced. So if a market moves too fast in a certain direction too quickly, then a certain stock will be taken for a couple of seconds or a couple of minutes off the market to enable the market to get back to its senses. Because one thing traders are really worried about and really afraid of is when suddenly, let's say, the bids completely break away, like we've seen after the UK referendum, the Brexit referendum for the GBP USD. Suddenly we're staring into an abyss, or when surprisingly the Swiss franc got disconnected from the euro, suddenly the buy side completely broke away, and the market was shocked, right? Or when you think about this flash crash, there are also some YouTube videos where you can listen to market makers when they kind of call the prices and the desperation in their voice because suddenly the buy side of a market has gone outside smoking a fag, right? And then But abyss obviously is massively shocking for every trader and also for brokers because they find it really hard to manage their risk. Order book fade. That's the idea that they're so fast, the HFTs, that they can pull the market. Basically, they can pull liquidity in milliseconds, or they can add enormous pressure onto the order book, and thereby trying to exploit the market, right? Because they know that maybe in a run-up of a we have now what do we have every first Friday in a month we have unemployment numbers out of the US, and typically volumes compress ahead of the announcement, and then they expand immediately after the announcement. You can try to have an impact on liquidity for your personal gain. Or finally, momentum ignition, right? And I was basically talking about that partly already, that an HFT trader identifies a large order in the market and uses his extreme speed to get ahead of the order, move the price slightly, and get a better use that better execution to get a risk-free profit out of a trade. So really, really mean strategies. And again, the two schools of thought is like, all right, we know that HFT kind of brings some challenges with it and it needs to be regulated. But on the other side, we also have that kind of almost limitless liquidity, which we day traders like so much. So it's a two-edged sword. So to bring this together, before I make a summary, what are the learnings for a retail trader? So don't try to compete with HFT. They will win at the end of the day, as they have better tools, and they always have as this it's called information asymmetry. They always have that information advantage over you. Try to continue to look for your personal edge, focus on good execution, and I personally would not suggest that you scalp on a tick level. That's not to say that you can use tick level information, but you can use that, for example, to produce range bars that give you a different insight into the price action in the market and not necessarily give you an edge trading on an actual tick level. In HFT terms, you are just too slow. Think about it. You know, the time it takes for you to get the data from Blackwell through your BT or whatever provider is network in your computer, and then through the processor and the software MetaTrader get an analysis and a decision buy, sell, then send that back from software into the hardware, send it back to Blackwell, who will be very fast in the execution of your trade. That process just takes too long compared to an HFT trader who does all that on a hardware level at the speed of light, right? So you will always be that distance, at least that distance between London and Zurich that I used earlier as an example, behind an HFT trader. More likely the distance will be much, 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 much worse, right? So don't get sucked into that. So let me just to finish us out, let me just summarize what we've discussed. So we looked at the emergence of high frequency trading by looking at the example of 1815 where we had the Battle of Waterloo, and legend has it that a carrier pigeon then carried the information that Napoleon has been defeated to Nathan Rothschild at the Royal Exchange, who made then massive profits out of that. The same principle sits behind the idea that Spreadco networks created a straight line fiber network connection between Chicago and New York as a very secretive operation, which shaved off 3 milliseconds in the round trip connection time between Chicago and New York. And then they sold that super fast line to the market, and HFTs loved it because they could suddenly use create an arbitrage opportunity that they didn't have before, and it came to the emergence of that whole HFT industry. That was then superseded by microwave towers, and now we have lasers. And even if you think about a combination, let me give you another example. There is a laser connection in London that goes all the way to Land's End in the UK. That's the most western point. And that laser connection is then connected to a fiber cable that goes to the other side of the pond in the US, and then that it continues on a laser basis to the New York Stock Exchange or the Chicago Stock Exchange, right? So you can't compete with these people. And when we're talking about dark pools and the reason why they exist, right? Especially for large orders. But I can also tell you that HFTs have paid money for kind of getting a certain privilege in the dark pool, again, to create strategies to extract information, order information, to exploit dark pools also for their benefits, right? So the race is not over. It's always like, it's like in a war, or ahead of a war. It's like you try to improve your equipment and you just try to deploy a different strategy to benefit, and that's still what HFT is doing. And one idea to eliminate large parts of advantage of HFT would be to reduce the trading time to something like 100 milliseconds every day, right? Yeah, so hopefully that gave you a good overview into what I think is a highly fascinating topic, and hopefully it also reminded you to stay well clear of that as a retail trader. I wish you all a luck in trading. And yeah, we have more topics that we got from you. I think Paul Wallace will be talking about what is it, scalping strategies. So more interesting topics that we have discussed and will be discussing. And if there's anything you are interested in particular, please feel free to reach out. Very happy to create some content on that. So all the best for your trading, and I hope to talk to you soon. Bye bye.